Shannan Whitney, welcome back to Property Insights, mate.
G'day, Mark. Good to see you.
Good to start the new year off. So,
Indeed.
2024. A lot of fucking stuff being said, like people talking about interest rates, they're talking about property market. Why is the property market high, or relatively speaking high? Well, let's just talk about Sydney for the moment.
Yep.
Sydney has taken back all its losses that it first experienced when the interest rates first started going up.
Yep.
Taken them all back, plus some more. And in fact, Sydney's growing at a pretty rapid clip. Numbers of people arriving in Sydney quite high. 175,000 people come in the 2023 or 18-month period from 2022 to the end of 2023. That's a lot of people. You guys, BresicWhitney, pretty much are represented across most of the major parts of Sydney. In terms
major inner city, yep, 10 Ks of the city.
Yep. So like, north, south, east, west, inner west especially, Redfern areas like that, definitely where we are sitting now,
Yep.
which is where I know you from in the early days.
Yeah.
What's your prognosis? I'm a property buyer and I'm thinking about buying my house. It might be my second house, could be my third house, it might even be my first house. But I don't know whether I should buy now because I think prices are going to come down perhaps because everyone's talking about these high interest rate period, this long period of high interest rates. What do you say to those people?
Yeah, okay. So I think that 2024 looks to be the year we might see a transition in the cycle, probably more so based on behaviour and observations rather than pricing and data at this point. Probably main things we're seeing, the market. The behaviour of the market would suggest that they think that the rate rises have perhaps come to an end. And from what we've seen, the market for the first time in maybe 18 months, 2 years is starting to think about the factors ahead rather than the factors that they're dealing with right now.
What's that mean though?
I think in terms of buying, the buyers see that there'll be more pressure on prices going forward.
Pressure, what's that? Upward or downward pressure?
Probably pressure upwards, mainly due to the main thing being the rate cycle. I think the market think that right now there's more likelihood of seeing price rises over the next, perhaps the next calendar year. And I think we deal with a fairly sophisticated market. Most are educated, most have purchased before. And, from my observations, most people are looking at the market differently than they were in calendar 2023. We haven't seen that equate or translate into higher prices. Rather, we're seeing more buyers deciding quicker, certainly more decisive. And look, frankly, I think that, they think as the year goes on, they'll probably see prices go up.
So I remember sitting, I'm not sure if it was you or Tom Panos, I can't remember, it may have been both of you, but I remember sitting across from you guys in June last year, 2023, and either one of you or both of you said to me that when people were getting ready to sell in the spring period, that they would start to load up your book with inquiries. Look, I'm a vendor. I wouldn't mind selling in the spring period, because I can't hold on anymore. The interest rates are getting to me a little bit, and there seemed to be indications that there was going to be a bigger supply of real estate on the market for the spring period as a result of people talking to you guys as the vendor's agent about when they should sell, how much they should sell for, what do they need to do to get the joint ready for sale, et cetera, et cetera.
Yeah.
Did that happen? So did your spring last year have a bigger supply than, say, the previous spring, the spring of 2022?
Yeah, we did. And we did because, frankly, it's fairly clear that interest rates are having an impact on people's ability to maintain a lifestyle. And I'd say we don't see a lot of distress on the balance sheet. We don't see a lot of distress selling. But what we do see, and what we saw a lot last year, was the market feeling that interest rates was impinging on their general lifestyle. Therefore, disposing of assets, whether it be principal place or lifestyle assets, investment properties, was something we saw quite regularly. The reality is that the interest rate environment is still the same right now. So, is it having an impact on people right now? Yes.
But Shannan, did that extra supply, which sort of I thought it was pretty good news structurally, because you would always expect that might stop price rises or stop the price from galloping.
Yeah.
Did that extra supply result in a change And if so, which direction? Did it result in a change in prices?
Yes, we did see it. It was a moderate decline in prices. Q4 of 23 was probably one of the most challenging quarters we had last year. We had a rate rise in November, if you recall.
Yep.
We did have more stock to deal with, and yes, there was a lot of pressure on pricing. We found sell-through rates went down, and from
What's that mean, sell-through?
Sell-through rates, so clearance rates went down, days on market went out. A lot more property didn't get sold in Q4 23, and look, frankly, we thought that there was a moderation in price rises throughout
across
the end
Sydney.
of the year. Yes, mostly in all areas. Franchises? Mostly in all areas. I think you've got to take the premium trophy end of the market out. And you look at the average person, middle markets. Yes, we saw pricing generally ease.
When that happens, in my experience in the past, I don't mean in 2023, but in previous years gone by, previous decades gone by, generally speaking, the vendor's agent ends up with a fair bit of stock come 31 December. But I don't see a lot of stock around open in February this year. Did vendors sort of take a practical view, just say, listen, Shannan, what's the best price you got? Let's get rid of it, take the price. Is that what happened, or what happened?
So the carryover stock from 23 into this year was very high for us, and I think it's fair to say it was for a lot of people. So for example, our February listings are up. February listings on last year are up 30%. On where we were this time last year.
So in other words, carryover listings from 2022
Correct.
to 2023 compared to carryover listings from 23 to 24 is 30% more.
Correct.
By numbers of
volume.
Probably so across Sydney,
right.
pretty much.
Yeah, pretty much all in all our areas. And you add to that the new inventory coming onto the market now, in which it's been quite healthy from our observations.
There's a lot of new inventory coming in.
Yep. From our experience, and certainly from my colleagues in the industry, they're experiencing the same thing. A lot more inventory came into the system late January, February. And right now, as of the second week in February, we are carrying a healthy amount of stock, certainly up on the last 2 years from what we'd expect.
And so is the reason why the carryover from, let's call it December 2023 into February 24 is 30% higher. Is the reason for that is because vendors are being a bit stubborn about meeting the buyers in the market at price, or is it because there are no buyers in the market? In other words, like, you might have made an offer to the vendor, said in late December, listen, there's a bloke who'll pay $2 million for your joint, and he said, I want 2.3. Is that the reason, or is it there's just no buyers?
No, the former. It's because the disparity between the market and vendors' selling prices was too great.
So when you don't have, that's to me, a dysfunctional market when you don't have a willing seller and a willing buyer at a price because they can't meet. So that means there's no market. Well, that's a difficult position to be in. Is the thinking behind the vendors is that they're really feeling that, like you said before, it's more a lifestyle decision that they're doing because they're not desperate to sell or they're not in a distressed situation. So that's why maybe, is that the reason you say these are lifestyle decisions to sell? In other words, look, it would be nice if we could sell. We don't have the pressure of having to rent this joint and paying rates and all those other things, finding tenants and all that other stuff you have to do if you're an investor, for example. Is it just that, or is it that these investors or these owners of property have amassed some big savings, or is it because maybe they bought it for $500,000 20 years ago and is now worth $2 million? What's driving that thinking?
I think that's the case. In most cases, you've seen a meaningful capital growth, meaning capital experience. So they've made some money. Naturally, they think their exit price is probably aspirational, and certainly from what we saw at the end of last year, the caution on the buy side around pricing was very evident, particularly in Q4. The last rate rise at November most certainly had an impact, in my view, on buyers and on pricing. And as a result of that, many take the decision to pause and bet against the market into 2024. The bet is, have we seen the last rate rise, and are we going to see a change in direction? And if that's the case, will we see a market with potentially better prices and a better environment in 24? So far, it's a good sign. Does Sydney turn around that quick? The last cycle has been interesting in terms of the rises. From my observations, it feels like there is a much better environment, a much more optimistic and positive environment so far this year. But that, at this stage is quite early. We're only into week 8, so we're still yet to see. We haven't had enough, sort of auctions to really, sort of make a decision on that. But that's mostly why people hold their assets, because they're hoping that there'll be a better exit environment, in 6 or 12 months' time.
So it's very interesting because the psychology associated with the behaviour of both vendors and buyers is quite intense and dense, particularly when it comes to the vendors, because vendors are either in trouble and they've got to sell, or generally speaking, they're just selling. You said they just want to buy something else, or it's a lifestyle decision, or they're retiring, or whatever the case may be. Whereas buyers don't really have that fungibility, because a lot of them are borrowing money, and there's only a certain amount they can borrow.
Correct.
They can't increase their deposit. I mean, they might be able to, but generally speaking, they can't. They might be able to have a mum or dad who can lend some dough, whatever. But generally speaking, they get approved a certain amount of money, and they got a certain deposit, which they might have taken 5 years to save, and that's it. They can't pay a bigger price. Whereas the vendors are in a different position. They might have borrowed a little bit of money, or they might have paid down over the last 10 years or 5 years. They probably might have gone up double or triple since what they purchased for. So they're in a pretty good spot. So would you call it a vendor's market or a buyer's market now still?
I would call it a buyer's market still.
Buyer's market.
I do. Yeah, I still think that from my 30 years in looking at the various cycles, I felt that the last 18 months has been a very good environment for buyers, providing, of course, you can get funding in the current environment, and providing you feel comfortable in your job, and of course that your funding decisions and commitments don't impinge on your lifestyle too much. But in terms of the cycles that I've seen, I think that the pendulum has definitely been in the corner of the buyer, and so far I think that's likely to be the case at the moment. However, it does feel like we are on the precipice of a cycle change at some point.
It's funny you should say it, because some people I talk to, more economists, are saying that once the Reserve Bank governor stops her narrative when she recently said it in the parliamentary inquiry, the economic inquiry, that if inflation doesn't come under control and we get down to 2 to 3%, I'm going to put rates up again. We'll be forced to put rates up again. Once she changes that narrative to say, well, assuming this is the case, our growth, GDP doesn't look very good. Our unemployment numbers now at 4.5%, no longer 3.9%. Our inflation is now at 3%. Some economists, they're not agents, they don't know people, they don't talk to people, they just predict things, are saying that the property market is going to take off. Because all of a sudden interest rates are going to come down, people can borrow more money, lenders are going to be more inclined to lend more money, and as a result of that, the buyers all of a sudden have the ability to meet the vendors' expectations before the vendors think, shit, I can put the price up. So there's this period, like the vendors hang out for their price, like on the example I gave before, they want 2, the big get best offer is 1.8, they say no. They hang out. Then all of a sudden borrowers can borrow more money. They can now borrow up to enough to get pay to. But the vendors don't realise that they could be asking 2.2.
That's right.
And there's this little crossover that happens.
Right.
And it's not. It's hard to arbitrage the property market. It's very hard. But this is one of those opportunities that may exist now. And I know you're smiling at me because you're thinking to yourself, it's
for a period of time,
a very small, small window. Do you have come across purchasers who play that game?
Some, and I think some are acutely aware of how markets generally function. And in my experience, there will be a period of time, both in cycle changes, which are going in an upward and downward direction, where one side of the transaction are probably a little unaware of the power they hold, right? And that tends to happen in all periods. And I think that in terms of what I've seen over the last cycle with 13 consecutive rate rises in 12 months, in a short period of time, it has been surprising how resilient the market has been to be able to absorb that shock in such a short period. I would have expected there more distress on pricing.
Which is what the market expected, which is why the property prices come off so quickly at the beginning. It dropped 11% straight-wide, but maybe 12%, 9% in New South Wales or Sydney it was. But still it dropped. That was the expectation, but turned out not to be the case.
It didn't. And, there's got to be a lot of I think there's got to be a lot of turmoil to see a 10% drop in Sydney house prices. And we saw that. But, that was a very it was quite a violent period, to
Big
see.
reaction.
Yeah, very much. And I hadn't seen, the rate environment change so dramatically, so quickly.
I've never seen 13 rate rises. By the way, out of those 13 rate rises, 3 were 50 basis points. So it's really like 16, 17 rate rises over a period of 15 months or something. Like, it's crazy.
Yeah.
And it did have that reaction in the beginning, but as I said earlier, the market took it all back plus some more. So if we're looking at a situation, Shannan, where maybe sometime this year we're going to see this small window, you acting for vendors, you don't do buyer's agency, do you? No. So you just do vendor's agency. Yeah. So you've got a vendor and he hasn't been able to sell his joint. He's not on any financial stress at the moment, but he would like to sell his place. He wants $2 million. Best offer he's got is 1.9, but he's hell-bent on getting 2. What do you say to them? What would you say to them? What do you say to your vendor? Should you wait to the end of this year when the money markets are saying interest rates are going to come off? How do you advise your vendor?
Well, I think what we do firstly is in our role we do watch for changes in the energy and changes in buyer behaviour, and that's a very important, I think, step when you're assessing cycles. And firstly, you need to see that slight change in buyer perception. They think something's going to happen before it actually happens, and I tend to find that's what the market will do. And it feels like we're starting to see the market think about what is possibly going to change as opposed to it changing. Once we start to see that, it doesn't, of course, mean that it will happen, but if we think the market's generally right, then I think it's really a case for the vendor to sit, tighten up your boots, and you decide when the right time to exit for you is, and we'll sanity check that with what we're seeing on the street. And I think right now we will continue to see this slight change in energy from the market, and if the market continues to look forward, not look underneath what they're dealing with right now, that's a good sign in my view. And I've already sensed that this year. And I think then the vendors will need to decide when the right time to exit is. After 60 to 90 days of selling, we will be able to validate that in terms of a cross-section of the categories, the price points, the geographies, to really say, look, we're seeing demand and we're seeing bidding and pricing consistent, and it would sort of give us more confidence that you can probably go now.
So you're saying like April? Is that
end of March? Yeah,
end of March.
Yeah.
Okay, so
there's enough trading, I think, between by the end of March for you to get a pretty good.
So both buyers and vendors probably, and sort of, I'm not in your market, but it's my economic view is that if you don't need to sell and if you don't need to buy, unless it's an absolute bargain, and if it's in your wheelhouse and you've got the funds to buy it, then go and buy it now. But like if there's no necessity, no compulsion, then I would be waiting for the market to settle down. I agree. Sometime early April is the time, and you'll be able to see what's still around and what hasn't been sold, and assuming there's something there you like. And if you're a vendor, should I better take that price because that's the best price I'm going to get, or alternatively, just going to lock it up, rent it out, and wait until the next cycle. Yeah. Then you can make a few more decisions with certainty. Let's go towards the end of the year, this calendar year, and nothing to do with your clients, just a general view, Shannan Whitney's view. Interest rates come off a couple of times. There's 2 or 3 rate reductions. Let's say 2.
Okay.
And that's most of the banks are predicting too.
Yep.
Certainly by the end of the year, not all saying at the same period, but by the end of the year, let's say, September, October, spring this year, this calendar year, there's a rate reduction in the wings, maybe another one following. Everybody can borrow more money. We've got through whatever shit we've got to get through this year, whether it's a recession or whatever we've got to get through the next 6-7 months. But I would have thought there's no increase in supply. I mean, in the areas which you guys operate in the immediate part of the Sydney city, the environs, 10 Ks out of the city, either any direction, they're not going to build new housing. They're not going to build a new Darlinghurst. They're not going to build a new Inner West. They're not going to build a new Redfern. You can't. It's already built. What happens to prices then?
Up 5 to 7%.
Yeah, so if people work that shit out now, why aren't they all running out there buying with their ears pinned back, assuming they can get the finance?
Yeah, well, I think the reason for that is that, you need market validation, and at the moment it sounds like there's a good story out there. And, if there's one thing that I've seen with technology, visibility, the speed of things, I think people will pick up on themes quicker, and people tend to move through cycle changes quicker than they did a decade ago.
That's true.
It does feel that way. So I think if those things do happen, or anything that remotely resembles what you've just said, then you would expect to see price rises over 5%. Supply is genuinely an issue. Anyone who's been out there trying to rent a house or rent an apartment 10 Ks for the city would understand that. It's very difficult. It's probably the most intense rental market I've seen in, we manage 4,000 properties around the city fringe, and I've not seen anything like this in my 30 years. And I think that's a factor. I think that's a factor in people's decision. I think it encourages people, if they can, to buy. I think it pushes people into the first home categories. And look, frankly, I think it encourages people to try not to rent if they can, particularly if they're in the middle area. So I think that's the case. I would also say, Mark, from my observations, it's been purely an owner-occupier cycle. I've seen very little residential investment interest. And at this stage, with the lending environment, I haven't seen any change to that. I do a lot of mixed use, commercial.
I love this stuff.
Yeah, that sort of, it's been a fascinating cycle in terms of, where that asset category actually is right now. I tend to do 5 to 20 million on the fringe. There is a move away from commercial. Commercial investment is generally very weak. There's a huge amount of uncertainty there that certainly remains, and we're mostly looking at repurposing existing commercial buildings, historical commercial buildings, into some other form, and that I think has some time to go before we start to see where what shape that sort of starts to take. But that's a fascinating part of the market at the moment.
So, been around 30 years. I remember when you kicked this off with Ivan many years ago. Had the little shop up the road.
Yep, up the road.
And of course, you've expanded. Ivan's no longer there, but you've expanded into being a big business, and you get a lot of touch points in terms of data, what's going on around Sydney. And I ask you this every time I talk to you, not just on podcasts, but would you invest now if you had the spare cash and you take it out of your deposit, whatever you're earning? You could be earning 5.5% deposit, but would you take money out of a deposit now or a cash position and then borrow some money, and interest rates are a bit higher than normal? Would you go out and buy in the marketplace as an investor?
Only for a certain category, and that would be certainly a bias towards residential. I think probably the area of the market I think the most interesting as an investor would be multi-unit resi in the Inner West.
What is that? What's multi-unit resi?
Multi-unit resi consists of anything that sits blocks of units, boarding houses, new age boarding houses, anything that you can get approved by council where you can have multi-lettings within an existing building. Buy to rent versus build to rent seems to be an obvious choice for investors, say, 3 to 20 million. And I have to say, I think in terms of asset prices and return, rental demand, cultural and generational trends, I would have thought the inner west of Sydney is the most exciting and profitable area for
the inner west
property.
Sydney, just give me a bit of an idea of where we're talking about now.
I would say anywhere from Chippendale, so right on the western southern fringe of the CBD. So that's Chippendale, Redfern, and you push all the way out to now past probably Hurlston Park, which is down
Near Canterbury.
Yeah, near Canterbury. Actually, Canterbury's a good ring. All the way through there, in my view, if you look at rental demand, current rental prices, where asset prices are, the undeveloped nature geographically, to me, I think that's probably the fertile ground for property investment at the moment.
And last question for you, mate. The Premier, Chris Minns, who's sat in that chair a number of times, announced, I think it was yesterday, changes to zoning for houses. The changes basically sort of saying if you've got a 400, for example, I think it's 530 square metre block, something like that, and you've got a single house, a single dwelling on it, you can put now 3 houses on it, or 4 houses, something like that. What do you think about that? What do you think about the announcement?
They don't have a choice. I think that's a solution. They have to come up with solutions to increase supply. And to your point, I think you might have just been through a DA, a process with council.
Punish. And by the way, we lost.
And you lost. That's right. And that's been kind. There has to be a way to try and loosen up the system, and more creative development, planning, control changes like that are needed.
Yeah. Mate, thanks again, Shannan. As usual, your gems of experience and wisdom are, hard to get over. I mean, I really appreciate you coming in,
No worries,
especially for the start of 2024.
Yep.
Good on you, mate.
Good on you. See you, mate.